Hi, I'm Joe Perfetti. I'm a professor of finance, and I'd like to talk to you about the fundamentals of value creation. In this unit, we're going to focus on the concept of spread. We had previously defined the key value driver framework as having three main parts. First, spread. Second, sustainability. And third, growth. We want to give you a better understanding here of the concept of spread, what it means, and how to apply it. So I want to start out with a very simple example. Would you do the following? Let's say you had a line of credit for $10,000, and the bank would let you take a loan against this line of credit for 6%. Somebody comes up to you and says, hey, I get a great investment, makes 4%. Would you invest in that? Which means, would you borrow at 6 to make 4? Probably not. It's pretty obvious that you wouldn't do that. That would be value destruction. Well, the same principle applies for a company. So let me use some terminology here that we would use in the corporate world to illustrate the same principle. The amount of money that the bank gave us, in this case, that investors give a company, is called invested capital or capital employed. It would be the $10,000 in the previous example. The rate of return that we're charged by the bank is called the cost of the capital. That represents the rate of return we have to give on an annualized basis to investors to compensate them for the risk that we're taking. The 4%, which is what we make on the investment, is called the return on invested capital or the return on the capital employed. The difference between the two is called spread. Value is only going to be created when the return on the invested capital is greater than the cost of the capital. Now we can turn spread into a dollar-based framework. That's the concept of economic value added, or EVA. This is what the consulting firm Stern Stewart did, and this is a concept that is pretty simple. What they did is they said, using the previous example, let's say we borrowed $10,000 at 6%. That means we would have $600 of finance charge, or what they call capital charge. Let's say we invested $10,000 at 4%. That means we have $400 of profit. $400 of profit minus $600 of capital charge is $200 of negative economic value added, or EVA. Now, the rest of the world calls this economic profit, but it's basically a principle that says during a period of time, are we creating or destroying value in a dollar-based framework? We've given you a framework for key value drivers, and there's actually some math behind this. So I want you to understand the math that led to the framework. So when we talk about valuing a business, the difference between valuing a project and valuing a company is we assume companies last forever and projects come to an end. Well, when I predict the value of a business, I have to value you forever, which means I have to guess your cash flows forever. Well, it's really hard to do. So here's how we shortcut this. We use a mathematical equation called a growing perpetuity. And it says, if we have a constant cash flow that grows at a constant rate forever, at a certain level of risk, we can value that cash flow. Well, we do that for a business. We look at the cash flows the business generates, we look at the cost of capital for the business, and we look at its long-term growth rate. And this tells us what a business is going to be worth in the long term. This is the most widely used formula in the world today to look at what's called the continuing value or the long-term value of a business. Formula, though, has two challenges. Challenge number one, 3 values represent between 60 and 80% of the total value of your business. I know it's sad, but that's, as investors, how you're condensed. But the real problem I want to address is another math problem. And it says that the internal rate of return on existing investments will be the internal rate of return on all future investments. Translation, whatever you're making now as a return, you're going to make forever. So here's the challenge with this formula. If we apply this to a business that's doing well, it will do well forever, and it will never underperform, and will tend to overvalue the business. If we apply this formula to a business that's performing poorly, it'll do poorly forever, and it will never improve its performance, and will undervalue the business. This formula exaggerates the directionality of the performance of the business, and it doesn't give us a good view as to the long-term value of a business. So here's what the consulting firm McKinsey did to try and improve upon this. They rearranged the math, And what they did is they said, look, the cash flow of the business is the free cash flow of the business, which means profit after reinvestment, because this is the amount of cash that can be given to the investors. And second, free cash flow is profit times 1 minus the reinvestment rate. Well, they also note that growth is the reinvestment rate times the return on the invested capital that you achieve, which means the investment rate is the growth over the ROIC. Key point I want to make here is regardless of the math, the growing perpetuity rearranged is what McKinsey calls the key value driver formula. And what it helps us understand are what are the things that investors ultimately look for to drive value in a business long term. And we can use this formula to actually value a business long term. Notice the difference. In the original growing perpetuity formula, we talked about cash flow. In the revised key value driver formula, we talk about profit and return on invested capital, which, by the way, represent the cash flow or free cash flow of a business. The advantage of using this formula are really twofold. One, it's language that is easier to use and track within the business. If I ask a person what their cash flow is, they may not be certain. But if I ask you what your profits and return on investment are, that is much more easily understood and tracked. But more fundamentally, using this version of the formula, I can now change the return on invested capital for the future of the business, which means I can have a different ROIC for the future than what I had in the past. That's the real advantage of the key value driver formula. What I'd like to do is try and apply this formula to a scenario to understand how we would value a business. So what I'm going to do is I'm going to take two businesses, we'll call them Business A and Business B, they're peers in an industry, and using the key value drivers formula, I'm going to give you some assumptions and show you how we would value these businesses. So the 4 parts of the value formula are as follows. First, profit. Both companies have $100 million worth of profit. Both companies have a 10% cost of capital. Both companies are growing their profits and growing their cash flows at a 5% growth rate long term. The fourth value is the return on the invested capital. Business A has a return on invested capital of 10%. Business B has a return on invested capital of 20%. When I run these numbers through the key value drivers formula, it tells me that Business A is worth $1 billion and Business B is worth $1.5 billion. Business B is worth 50% more than Business A. As a matter of fact, there's a concept known as multiples. An enterprise value multiple or a PE multiple is an example, where I take the value, in this case for Business A, $1 billion, and I divide it by the earnings, 100 million, and that gets me a multiple of 10. Business A trades at 10 times their profits. Business B trades at 15 times. So Business B is worth absolutely more, and Business B also's earnings are more valuable to investors. Well, let's think about why. Look at all the data on the screen. And the major difference between A and B is B has a higher return on its investment. That's the key. If you have a higher return on your invested capital, you will generate more cash flow for the same amount of profits, and your business will be more valuable. Return on invested capital is a proxy or a shortcut for the cash flows of the business. This formula also highlights the real drivers of what makes earnings more valuable. And if you think about it, it's growth and spread. It's the return on the invested capital, the cost of capital, and the risk that you took. And then it's also how you grow that over time. So let's do a little simulation and see how these variables change and how that will affect the value and multiple of the business. So let's say both of these businesses want to grow. All businesses want to grow at a faster rate. So instead of growing at 5% long term, both businesses grow at 6% long term. Let's see what happens as we change the growth rate. Here's 6%. Here's 7%. Here's 8%. Here's 9%. What you'll notice is that Business A's value isn't changing as the growth changes. And Business B's value is going up exponentially as the growth rate changes. Let's talk about why. Business A has no spread. Business A is borrowing from investors at 10%, and they're reinvesting in their business, making a 10% rate of return. 10 minus 10, no value. So no matter how fast they grow, it's almost like a treadmill. They're just running really fast. They're not going anywhere from a value creation standpoint. Business B is borrowing from investors at 10%, and they're making 20%. The more of it they do, the more value they create at an even faster rate. That's what makes them more valuable. Let's reset the simulation back to the 5% growth rate. Now let's see what happens as the growth slows. Let's see what 4% looks like. Let's see what 3% looks like. Notice that business B's value is going down. Now that might initially surprise you because business B is still earning a terrific return on its investment. The challenge for business B, though, is I expected it to earn that return on investment given a 5% growth rate. It's not earning as much of that 20% anymore. Its growth is slowing, which means it becomes less valuable over time. So this is a highlight of why expectations are so important to a business. Because even if I earn great rates of return and my growth starts to slow, I become less valuable over time. Let me give you an additional scenario. Let's reset the data back to a 5% growth rate. But this time, let's have business A have a negative spread. Let's change its return on invested capital to 8%. You'll notice that the value of business A is now much lower and the multiple is now lower. But let's start growing business A. As business A grows at 6%, notice that the value and the multiple gets lower. As business A grows at 7%, it gets even lower. Here's the point. As it's growing a negative spread, it's destroying value at a faster rate. So what are you going to do if you're the CEO of business A? Watch what happens as the growth slows. If we go back to 5%, this is where we started. Now let's look at 4%. Now let's look at 3%. Now let's look at 2%. Now let's look at negative 2%. The more you shrink, the more value you create. And the reason why is because what we're doing is avoiding those negative spread opportunities. So in that case, we want to disinvest because we don't want to keep borrowing at 10 and making 8. The less of it we do, the more value that we create. So what this illustrates is back to the key value drivers that growth doesn't create value. I'm going to say that again because it can be very controversial. Growth doesn't create value. Growth is an accelerant. It's gasoline on a fire. And ultimately, growth is the combination that we have to look at with spread to think about value creation. When we have a positive spread, when we earn good returns on the invested capital, that's when we want to step on the gas. That's when we want to accelerate our investments. That's when we will create value at a faster rate. However, when we don't have good opportunities, when we don't have good return on our invested capital, then we don't want to step on the gas. That's when we want to grow at a slower rate or even disinvest because we want to avoid those bad growth, those negative value destructing activities. And that's what the key value driver formula helps us understand. It's the growth spread combination. And then it gets back to sustainability because even if business B is earning a great rate of return, how long are they going to be able to sustain that great rate of return? Because competitors are going to notice, markets are going to mature, technology is going to change. And we have to think about that from an investor point of view. That's why this is called the key value drivers. Summing up, the core principles of this model are very critical to value creation. We talked about the concept of spread, and we talked about how critical spread was to value creation. We also really focused on the math behind the key value drivers and understood the relationship between spread and growth, and ultimately defined that value creation is about earning a good return and finding good growth opportunities that earn that good spread growth combination. And what we want to avoid, the bad growth, is where we don't earn a good rate of return or have a negative spread. We don't want to grow those opportunities. So we have to be disciplined in our growth and disciplined in our process to differentiate between good and bad investments.